Timing the markets or time in the markets? Which provides better returns? Over the past 37 years, the S&P 500 Total Return Index, which by the way includes reinvestment of dividends, has returned about an 11% compound annual growth rate. But let's look at how time has affected those returns and what investors would have experienced if they were paying attention. Now, that 11% compound annual growth rate doesn't mean the S&P 500 with dividends has returned 11% each year. But over that 37-year period, the annual growth rate averaged 11%. Let's take a look at those returns over different time periods to better understand why time in the markets matters more. To better understand this, let's take a look at one-day returns of the S&P 500, the Total Return Index, over the past 37 years. Well, you can see if we look back one day, the number of periods that were up were 5,034, and the number of down periods, or the number of down days, were 4,227. So 54% of these periods were up, 46% were down, and the median returns were just about even. So up days, there were 0.52% median return, and for down days, we had a minus 0.51% median return. So pretty much even here, slightly more for up days. So what happens if we go out to 5 trading days, which is a week? So now you'll see that this number went up. So now we have 5,435 up weeks. Now remember, we're looking back every single day during the 37 years. We're looking back a week and saying how many of them were up and then how many of them were down. So 59% were up, 41% were down. So these numbers are starting to improve as we lengthen the time we're going to look at. And by the way, the return went up relative to the loss for that 5 trading day period. Let's go out to 21 trading days, which is a month. And again, this number gets bigger, this number gets smaller. Now we're at 65% up months. Again, we're looking back every day. That's why there's so many of them here. And we have 35% down months when we look back a month every single trading day over that 37 years. And the return for the up days increased a little more, while the loss for the down periods got a little bit worse. Now let's look at a quarter. So 63 trading days. And you can see these numbers are increasing again. 73% up, 27% down. And now we're getting a 5.47% monthly return when we look back every day. We look back a month every day over that 37-year period. And the median loss is minus 3.92%. So this ratio is continuing to improve as we go out longer and longer in duration. Well, let's just jump ahead and go to an entire trading year, which is roughly 252 trading days. Well, now we're hitting the 80-20 rule pretty much. We've got 82% of the years were up. So every day we look back a year and say, how much were we up or down? Well, 82% of those were up and 18% were down when we look back. But look at the median return, 16.48% when we look back a year, every single day during the 37 years. And for the negative returns, we're at minus 12.76%. So the longer you go out in time, the more this works in your favor. You're getting more upside. Yeah, this is still a substantial loss if you look back over a year, but you're getting many, many more periods of return than you are of loss, which translates to good returns over the long term. What's really clear from this analysis is that a longer time in the markets makes all the difference to your returns if you can be a patient investor. Do you rebalance your portfolio often by selling to lock in your gains? Or do you just let your gains ride over the long term? Hopefully this video will convince you to be much less active by letting time work in your favor. With all that, let's go through the current health of the stock, bond, gold, and crypto markets.
let you down.
Well, if we take a look at the equity markets over the past week, you can see we had a very nice rally here with small caps finishing up the most, ARK Invest second, the Dow third. I'd rather see that be last. And then we had the S&P and the NASDAQ pretty much tied. So this is a fairly healthy appetite for equity risk. And if we look back over the past month, you can see we've had a very nice rally here with ARK finishing on the top, which is where you want to see it. Small cap second, where you want to see them. I don't like the Dow being ahead of the NASDAQ, but that's the way it is. So a fairly healthy appetite for equity risk here. And then let's just jump to the past year. Well, you can see we've had a very nice year in terms of returns. Now, ARK Invest is not ranked number one, but you can see how quickly it moved up here. And if that continues, it will surpass all of these other ones. I do like the fact that small caps are ahead of the Dow, which is somewhere down here. And they're also ahead of the NASDAQ 100 and the S&P 500, which are all kind of bunched together here. And how does all of this show up in the current bottom dynamics? Well, if we take a look at this, we have a rising price in the S&P 500, this black line, over the past 2 months. It's not a rip-roaring rally. It's somewhat tentative. So I would call this rally optimistic, but uncertain. And you can see that in terms of this risk confidence, which is this black dashed line. You can see that while it was up here, it looks like 90+% back here in September, it just collapsed, went down to, call it 35%, came up to 80%, kind of hovering around here, dropping. It's all over the map. So there's really not a lot of confidence. Now, currently, it's sitting here, looks like probably 80+, 85+%, and pointing higher. So that's a good sign. So hopefully this will continue going forward into next week. And what if we look at risk versus opportunity? Well, I like where these are sitting. You have risk acceleration, which is my go-to, the yellow line. You can see it's down here just above 30. I don't like the fact that it's moving higher, but I like the fact that it's way down here. Risk, the red line, which is a very laggy indicator, down here just touching 40. That's a good place for it. I'm very comfortable there. And then you've got opportunity acceleration, the purple line, which was moving higher and has lately been kind of dwindling away here, but it's at a healthy level above 50, probably around 55. And then opportunity, which is very laggy, peaked out here just above 60 and has since fallen probably, let's call it 58 or so, and is pointing down. But this relationship is pretty healthy. You want opportunity and opportunity acceleration to be higher than risk and risk acceleration. So this looks fairly positive. Well, what about equity versus safety? Well, let's jump right into the overlays. So if we take a look at what's been going on here, and you saw this when I showed performance over the past week and past month, you can see that small caps have done extremely well. They're ranked number one. You have the Dow second, and we saw some of this in the price movements. And then the NASDAQ 100 fell from second down to fourth, and the S&P 500 moved from fourth up to third. But what do I like here? I like the fact that all the equities are ranked 1, 2, 3, and 4. I'd like to see the NASDAQ 100, up here in second place, SPY in third, and the Dow last. But, you can't have perfection. And I like the fact that cash is staying put. Now, what about safe haven assets? Well, if we look at safe haven assets, this has been kind of stuck here for a while. We've got cash ranked 5, short duration treasury 6, intermediate 7, 20-year bonds 8, longer duration bonds 9, and gold dead last. So this is not a healthy relationship for treasuries. If you're a bond investor, you'll feel this. These have been pulling back over the last several weeks, and you'll see that when we get into some of the charts later. How does all of this show up in the buying and selling pressure? Well, you can see we've had a pretty jagged couple of months here with the Dow going up, falling back, rising rapidly, falling back, going up. And you can see that in the buying and selling pressure. The gray line is the buying pressure, really fell off here, and now it's shooting higher. Same thing for the S&P 500, very jagged performance. NASDAQ 100, same thing. And small caps, again, jagged, but, very nice upward trend overall. Now, one thing I will point out, and you've heard me mention this in my previous videos, when the buying pressure, the solid gray line, gets up here at 8 or above, you're typically kind of running out of steam, and you can see that here. And then the market pulled back. You can see it here. This got up above 6, for the S&P 500, and then we had a little bit of a pullback for the NASDAQ 100. Got up above 6, started to falter, and so did the price movement of the NASDAQ 100. Same thing for small caps. This peaked out, and then the buying pressure started to falter while the price continued higher. That's a divergence. That can't last. And you see what happened. And then what about ARK Invest? Well, same picture. You've got the buying pressure peaking out up here, started to fall back, and so did the price. Now, ARK is trying to make a comeback here, and we'll see how this plays out next week. What about sector rankings? Now, these move very slowly, as you've heard me mention in my previous videos. So we're going to jump right into sector rank acceleration because these move more quickly, give you more of a sense of where we are or where we're headed. So what looks good? Well, a fair amount. You've got Bitcoin ranked number 1, ARK Innovation ranked number 2. I theoretically could make these both green because they have nowhere else to go. They're right up at the top. We've got the NASDAQ 100 moving up a notch. Small cap companies, as you could probably guess, moved up a lot. Clean energy, which is twofold, right? It's innovative technologies doing well for energy production, but it's also being driven by the need for electricity to run AI compute. And then we have the Dow Jones Industrial Average, which are safer equities moving up, and I make that line brown because it's both good and bad. Yeah, they're equities, they're moving up, but they're safer equities, and you want the riskier equities to be moving up. Consumer staples stayed put, same sort of thing. These are safer equities. Emerging companies, the smaller NASDAQ stocks that are below the NASDAQ 100 stocks, staying put, so that's yellow. And then gold is all the way at the bottom. So I made this green because I like the fact that this is basically saying no risk anywhere. Now, what doesn't look good? Well, there's a fair amount here too. You can see that consumer discretionary went from 3rd place all the way down to 2nd to last. That's a heck of a move. You can see that the semiconductors moved down. You can see that S&P 500 moved down. You can see that cash moved up. I don't like it when cash is moving up in the rankings. And then I only put one red line in here for treasuries, and I decided to focus on intermediate treasuries. And you can see that they went from way down here all the way up to here, which to me implies somewhat of a flight to safety. So I view that as a negative. So speaking about treasuries, how do they look? Well, if we look back over the past week, we've had a very nice, healthy rally with the longest duration treasuries ranked first, 20-year treasuries second, and so on right down the line. This is a very healthy treasury relationship. And if this continues, equity versus safety will eventually start to flip over and look a lot better. But the reason it doesn't look better is look at this. So if we look back over the past month, you've got longest duration treasuries on the bottom, 20-year bonds on the second to the bottom, and so on. So this is an unhealthy appetite for treasury risk. And then if we go out to 1 year, you can see we're back right where we started a year ago. So we had a big rally, pullback, big rally, pullback. I'm really hopeful that we're going to see a very nice rally in the upcoming weeks going into 2025. And how does all of this show up in the buying and selling pressure? Well, you can see from the price movement, the black line, the short duration treasuries have been declining. And you can see that we also have declining selling pressure as these have been declining. And I've kind of pointed that out here for 7 to 10 year and 20-year treasuries. So we'll talk about those. For intermediate treasuries, very similar picture, declining price, but declining selling pressure, which is a divergence. Now I've put overlays here to show that for 7 to 10-year treasuries, declining price, but declining selling pressure, and rising buying pressure. That's a divergence. Now what do we have? Well, it bottomed out here, and now the price is starting to move higher and respond to this upswing in buying pressure. And then if we look at 20-year treasuries, very similar. Of divergence, we've got declining price, but we have declining selling pressure, rising buying pressure. What about that yield curve? Well, it's uninverted for sure. You can see that not by much, though. We're only a little bit less than 3 basis points uninverted. So we're getting close to being inverted again. But you can see what's happened. The 2-year has been kind of stuck here, although a month ago it was quite a bit lower in yield. But the 10-year has been kind of moving up. So we've got a very close to an inversion again. And this will resolve itself as the Fed continues to lower interest rates. And speaking of that, what's going to happen when the Fed meets in 3 weeks? Well, the markets have really moderated their stance here. A few weeks ago, let's look at this. The previous week, we had a 63% probability that the Fed would lower rates by 0.25%. Now, I think if you go back even before this was probably quite a bit higher. But the Fed made some comments that led people to believe they might not lower rates when they meet in a few weeks, but there's still better than 50% chance here. The markets think that the Fed will lower by 0.25%. Well, if we go out to January, you can see that now, this has actually shrunk a little bit, but there's more of a likelihood that they'll lower rates by 0.5%. So very likely they'll lower by 0.25% by then, but an increasing likelihood that they'll lower rates by 0.5%. Now, if we go out to March, so now, almost definitely they'll be lower by 0.25%. But you can see these really moderated. If you go back a few weeks, these numbers for rates staying the same were much lower. In fact, let's look at that. 18%, 12. They were 12% here, 24% versus 35% here, and 36% versus 45%. So the markets have really started to fear that inflation is going to be an issue and the Fed's not going to lower rates as quickly as everyone thought. And what about gold? Well, gold has been a real tough ride. There's been some risk in the world, and gold rallied, and then it pulled back, and now it's trying to rally again, but hasn't been much fun to be there. It ends up just running out of steam and going nowhere. And what about Bitcoin? Now, Bitcoin has been the place to be, and you can see what's happened here. We had buying pressure here falling off, and then a rally in Bitcoin. Buying pressure peaked out, fell off. Now Bitcoin really took off here, and the buying pressure went through the roof. Now, when you get up to these levels, it's going to pull back, but it didn't pull back much, which attests to the strength of this rally. And even as the buying pressure plummeted and continued to fall, the price has moved higher. And now more recently, the buying pressure is pointing higher. So this could be interesting next week. As you can see from the price movements and metrics, the equity markets and treasuries are slightly optimistic but cautious because of the uncertainty over the coming several weeks and months. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, And thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.